Now we'll turn to the EU and Europe in general, because we really want to understand, what is happening based on COVID. We expected to see some pops in February, and then as COVID increased in March and then resulted in more lockdowns, we expected to see some slowdown. We're starting to see some of that. It's a bit mixed. So let's just start here. So advanced European economies are expected to cut their extra fiscal support from 7.5% of GDP in 2020 to about 6.5% this year, is what the IMF is saying. So the question is going to be, ECB is talking about building more of a cushion to make sure that they can continue to ease and support the economy. And when we look at the Eurozone aggregate, so let's look at, the investor confidence. So investor confidence is shifting higher, but we had the unemployment rate also creeping up. Then we had service PMI getting flattish, 49.6, with the Eurozone composite, getting a little bit better to 53.2. PPI is trending up, and that continued in March. Then we look at retail sales, and retail sales had got better, and now their March is indicating a little bit lower. So we're starting to see, again, these mixtures, but the bigger issue here is going to be industrial production, because on an aggregate, industrial production actually went below estimates when we look at where things are going. And when we talk about that, we want to break it out into Germany and France, because France was the one that saw a bit more of the pressure that I think became a much bigger issue. So let's just talk about Germany for a second. So when we look at Germany, Germany's economic institutes cut joint GDP growth forecast for 2021 to 3.7% from 4.7% previously. And this is what we were talking about in segment one, and this is what I've been talking about when I look at what's happening in Germany and Europe in general. And Germany being the biggest growth driver, that coming down, I think, speaks to some of the issues and pain points that we continue to see in the international market, because Europe is an exporting economy, and they continue to see issues in the exporting side as PPI is driving higher, as costs are driving up, and this is becoming a much bigger overhang. Now, services beat to the upside, 51.5, composite beat to the upside of 57.3. So we're still getting some of that growth, but factory orders were fairly flat. German construction is still negative, but industrial production was negative. And this is what we see in February, where we had this surge, we had this benefit, and now we're starting to see some of the slowdown come through in February on the industrial side. Some of that carried through to March. And again, this is why we're starting to see some of that impact, as we did see exports disappoint to the downside. Small, they was expected to be at 1%. It came in at 0.9, but imports were up. So imports being up is a net positive for exports, because it means that you're taking in that raw materials, and imports beat sizably. It went from 2.1 expectation of 2.1% to 3.6%. So we should see that bounce in exports. So industrial production will turn around, and it will come back from the low of Feb. But again, COVID became an issue. Local demand became an issue, which means that the exports could just be what is not being consumed locally. And then when you look at the survey expectations, the ZEW survey expectations, they were expected to be at 79, came in at 70.7. Current situation was supposed to be at negative 54.1, came in at negative 48.8. So there's some adjustments, and the problem is expectations are starting to get tempered as we see some of the pressure coming in, as we see pricing coming up, and some of those rolling issues that I think are going to become a bigger headwind, especially for the exporting countries, as their trade partners maybe try to find a way to adjust, or a way to find a other option or lower cost, which again is going to slow down some of those things. Now, when we look at France, France service PMI beat 48.2 from expectation of 47.8. Composite PMI came in at 50 versus what it was expected at 49.5. A net kind of benefit in general, but Industrial production in February on month over month was down 4.7% versus an expected increase of 0.5%. And year over year, it was expected to be down negative 0.2%. Instead, it was down negative 0.66%. So we're seeing some of these headwinds starting to get baked in. And again, this is Feb. We're looking forward now. But we're seeing some of this residual that as the slowdowns increase, COVID cases increased, you're starting to see some of those continuation. Like manufacturing production was expected to be up 1%. It was actually down 4.6% in February. Year over year was down 7.1%. But the Bank of France industrial sentiment was slightly better at 105. So you're going to see a little bit of an increase in March, but we came so far down in February that we're still not going to be able to cross that level as we see domestic demand being hurt and just general activity within Europe remaining very slow, especially as COVID cases increase. And what COVID cases increasing does, you don't need, given you'll have lockdowns, you'll have government forced, but you're also going to change, the consumer is going to change behaviors. And that's where we continue to see, and this is also going to be an impact because we're also getting pressure on inflation. We're getting PPI higher. We're getting, inflation pressures to the upside. And that's why when we look at things like Spain, so Spain was able to surprise to the upside on PMI. You're getting Italy that was surprising to the downside. So you're getting this mixture of what makes the most sense going forward, with CPI coming in at 1.9%, and we talked about this last week, versus in places like the Netherlands, you're getting Spain with an increase of 1.1% year over year, but month over month, you're down 0.2%. So you're still, there's a mixture, and there's the haves and have-nots, as there always has been when we look at the pigs from 2011, or Portugal, Italy, Ireland, Greece, and Spain, and you start to see these pressures in terms of who's going to benefit the most. And with Germany being the driving force as they slow down, that's going to put pressure in general. And what does that pressure mean? Well, production dropped in Germany and France, which again are the biggest drivers of some of this. And when you have that production coming down in France and Germany, again, that's going to weigh on what is GDP expectations. What is that going to be going forward? What are your borrowing capacity going to be? And as the euro remains at right now it's $1.1979, that's going to limit how much pricing can you push through? Can people afford that, or are they going to go somewhere else as export prices continue to drift higher? Then when we look at Europe is becoming more sensitive to the world, this is what we've been talking about with as they try to go into the international market, they've gotten more linked to China, they've gotten more linked to the U.S. in different ways, and trying to get a bigger piece of the world as the EU, as a collective negotiating force. And that's why as global growth has started to come down a bit, or started to pare back, you're starting to see that pressure in Euro and Germany. And then from the 3-year rolling regression of nominal GDP growth, with Chinese nominal GDP growth being the key, as that's rolled over, we're seeing some of, obviously, Germany and Euro. Now, Merkel and Xi had a conversation. They tried to show that they're going to continue to talk, remain open. It's Europe is supposed to sign a new trade deal, and it's been thrown into question on will that be signed, given the friction that has increased on human rights, and that's where we have to continue to look at what is going to happen in general, and where is this going to go on a unity level. Like, are we going to see additional trade because Germany, who is a driving force behind European growth, is going to be highly impacted by that. But when we look at debt in general, so Italy and French banks are the biggest owners, so exposure of banks to domestic government debt. And here you can see that Italy and France continue to be that, Italy being the largest, but France has really caught up after being, let's just say, very good at mitigating some of those those tendencies, and it's also kept some of that away from the consumer, especially in Italy, because Italy has been very active. Draghi is going to push through another $40 billion euro stimulus package to try to, again, keep that money moving through. But you're going to have to issue debt to do that. And then the banks have been buying that debt, and you get this negative feedback loop, which became a huge problem when we looked at into 2011, when we look at Germany and into France. And those are things that have to be considered when you're looking at what is the ECB going to buy, how are they going to continue to manage these debt levels, because they want to maintain a certain amount of ease. Now, Euro area annual inflation for March 2021, on a percentage level, you can see that 2020, we were up, the estimate was 1.3%, the monthly rate to be at 0.9, and energy being the biggest driver behind that. But so is food. So food, alcohol, and tobacco continue to be a big driver of over 1%. Energy was the increase of about 4.3%. Again, these are estimates, by the way, but just based on what we saw with our energy, it's very likely that we're going to see something similar. And that's why we continue to remain concerned on what does inflation look like, especially when we look at PPI and those export prices, import prices, which are going to get passed through, and Europe is no exception. So then when we look at declining consumption, so consumption in the Euro area continues to go down as the consumer just doesn't have the discretionary cash. And this has been an issue, essentially since the 08 crisis, and the capex and net exports became the biggest driver as you look to sell less at home and more abroad, which again links to how they need to try to increase or facilitate more global trade. And that's going to be difficult at some of these current ratios. But while this is happening, the financial conditions continue to improve within Europe, because they're trying to get people to borrow. They're trying to move some of this cash through to get businesses hiring, get them through these extended lockdowns that have now been pushed into May. Which is why, again, April is going to be tough, and the question is going to be, what does May look like? And unless they can get and accelerate some of these vaccinations, we're going to see, again, a reopening is going to happen. That's no question. It's going to be a matter of how quickly and how freely are people willing to move around with some of those headwinds afoot. Now, when we look at manufacturing in France, so this is just looking at the retail trade confidence index. So again, retail trade, when we look at what is happening on the retail side, what is happening with the consumer, you're starting to get this bifurcation on manufacturing and what the retail is doing. And that's why we think that the retail, just based on where we see, you'll start to see some of this get a little bit better. So again, France is moving in the right direction in terms of getting some of this normalcy back. But when we look at bank exposures, you can see that, given it's smaller than it was in 2020, in 2017, you still have a lot of exposure to Turkey, especially Spain. We've talked about Spanish exposure to Turkey. And as Turkey continues to struggle, this is going to put additional pressure on Spain, which relies so much on tourism, because Spain in general has had some okay numbers, but again, they're not confidence inducing, I think is the best way to put it. Because when you look at CPI, CPI month over month up 1%, CPI year over year up 1.3%, core up 0.4% month over month. And then you look at industrial output. Industrial output in Feb was down 3.4%. Industrial, year over year, and month over month, industrial output was expected to be up 0.7%. Instead, it was flat. These are things where Spain relies so much on tourism, and without tourism, they're going to need industrial to come back, and they're still going to have these headwinds. So they're going to get more support from the ECB as they increase their PEPP purchases and other purchases under that umbrella to try to keep Europe solvent while they're trying to come out of these lockdowns as they continue to get extended. Again, these are some of those headwinds that we continue to see in Europe, which is why we took down our estimates earlier. Now the market's starting to catch up, and it's just that's going to, again, cap where's oil demand, refined products, which is going to, again, limit the amount we export into Europe and increase the amount they export into the U.S., i.e. the East Coast and Gulf of Mexico. So again, there's going to be a lot of things to watch as Europe. And I know we try to cover a lot because there's all these different countries, and we try to pick out specific ones at each point in time, always Germany, just given the size. But if you want us to talk about anything specifically within Europe, we'd love to hear from you, because, to make this piece a bit more engaging and things that you maybe want to hear more about within the region. So, now we get to turn to some of our favorite topics, which is Asia.